to listen to what we have to say. So we'll make this short and sweet, and then take any questions that you guys have out there to give you kind of an overview of everything. So give you just a little tiny bit of background on myself, and a little bit on the company. For myself, I was born and raised here in Reno, Nevada, and I've got 4 kids. And actually, my wife says I have to say we have 4 kids. I keep getting in trouble when I say I have 4 kids. My wife and I have 4 kids. My wife and I have been married now for, what is it going to be? It's going to be 32 years this year in October. So yeah, there's a nice little picture of the family there. You can see my daughter is right there in the middle in the white, being stood over by her 2 tall brothers. And then I've got 3 boys. So my oldest son, Hayden, is in the Air Force. He's in the red shirt there. He is based in Japan, and that's Taylor, his wife. And then to the left of him is my middle son, Tate. And then Dexter is my youngest son in the middle, my wife next to him, and then me, and then Will is my daughter's longtime boyfriend. So give you a little bit of a feel for where I come from. We had a really fun time this last summer when we got to go visit Hayden in Japan. First time we'd ever been there, and it was just a blast because we got to go there as a family in the whole thing. As for Hughes Private Capital, we've been around for the last 11 years, a little bit longer than that now, and we run multiple funds. And so we're going to talk about the one fund that we're working on nowadays, and we'll take you into all of that and tell you how we can, or you can participate and be part of it. All right, well, so let me give you a little bit of background on what we do for our investments. So we buy homes that are in the Midwest. We call them always affordable homes because these are homes that are in the core rental market, and they're about $75,000 to maybe $150,000 or so. 150 is kind of really getting on the high side for us. We really try to stay in that lower end of the market for a few different reasons, which we will talk about here. We buy right now in Cleveland and in Akron and also Toledo. So those are the 3 places in Ohio that we buy. And then our other 2 main cities are St. Louis and Birmingham, Alabama. So these homes that we buy them very, very specifically for a reason of that they don't fluctuate up and down in value a whole lot. They stay pretty stable, and they have a really good rent ratio, meaning we're going to get a better rent for a lower value home as compared to maybe where a lot of times what people are used to. Here in Reno, we might get a 0.5% in rent per month of what the value of the home is, where when we're buying in the Midwest, we're usually getting about 1 to 1.2% of the rent ratio on the value of those homes. So you can see we get a much better rent there and a yield. So because these homes don't fluctuate up and down in value a whole lot, there isn't really an appreciation play with these homes. Now they will appreciate over time, but it's small. It's usually in the 1 to maybe 3% range in the long run. So we've always built this entire deal on doing it through cash flow. So we want to have cash flow coming from these properties. And the other piece of that helps us is we're not having to try to time the market, since the homes don't go up and down in value. And it's really not even really that important to us. What's important is that we can get the right buy, we can get the right rehab done on them, and put a tenant in them, and have the right rent ratio to what we're looking for on that piece of property. And so that's been working very well for us. So whether the economy's up or the economy's down, that doesn't really affect what's happening for us. Now, will we get some better buys maybe here as things kind of go possibly into a recessionary type of pricing? Yeah, we're probably going to do a little bit better, but it's not going to be extraordinarily better for us from that perspective. So but that also means that we don't have to worry about when things are a little bit higher because it doesn't affect us. We're always buying within our criteria of all of that. So that kind of gives you an idea of what we're doing that's out there with those homes, and what we're putting within. We have a couple ways that we'll talk about here, of the way that we go about investing. So, Ashley, do you want to jump in and ask any questions, or you want me to just keep going on this part here? So
I
I
would
know
be
sometimes you
happy.
kind of like to do it the other way. I put the pressure
Sure.
on you to come up with some good stuff.
That is fine. That is what I'm here for. So I'm happy to ask
Okay,
questions.
good.
So the main one is that Hughes Capital offers more than one option for recession-resistant investing. Can you give us an overview of those two options and where they differ or share similarities?
Sure, sure. Yep. Yeah, so there really are two ways that you can come into and participate with us as an investor. So the first way and the easiest way is that we run a fund. So we have what we call the buy and hold fund, and because that's what we're doing, right? We're buying these homes, we're rehabbing them, we're putting a tenant into the fund. And it's very easy. You put X amount of dollars in as an investor. That X amount of dollars represents your pro rata share of what you would own inside of the fund. And today, I think we just looked at this the other day, it was about 28 million or so. It sits inside of the fund. So your investment represents that much at the end of each month. You get your pro rata share of the net profits on that. And then, so the fund is producing today at 8.6% return. You also get the depreciation at the end of the year, and the depreciation will add another point, maybe 0.5% for you. So that's the first and probably the easiest way to do it. However, we have people that like to have their names on the titles of the properties. Now, that's something you don't have when you're inside the fund. And so if you are one of those people, or you're doing a 1031 exchange where you're required to have your name on the title of the properties, we do what's called a secured portfolio for you. And we call it secured because your name goes on the title of the property, therefore you're secured by that piece of property. However, those properties that we would literally sell to you don't really matter at all, because we're going to lease those properties once we sell it to you back from you, and we're going to put it back into our portfolio of the entire amount that we manage, which is today right around this about 750 doors is what we have in the portfolio. So what that does is it gives you a tremendous amount of diversification with all of that, and a really good safety net because we're geographically diversified, plus diversified over 750 homes. So now let's just use an example. We've sold you 5 homes. You've come in, your name is now on the title. We're going to then pay you a set monthly income for those homes as we lease them back for you. And we take over all the responsibilities and all the performance issues of those homes, except for one single expense, and that's the owner's insurance. And you're responsible for the owner's insurance. However, we'll help you to set it up. We'll help you to even pay it, but it is an expense out of your pocket. But it is the only expense that you have. Then everything that happens with those homes becomes our problem. It doesn't become your problem. So in case the hot water heater breaks and it's got to be fixed, we go out and we fix the hot water heater, and we pay for it. And you don't even know that we did it on that home that has your name on the title. Anything that happens, again, if it's vacant, it doesn't matter. We're still going to turn around and pay you a set monthly income, and we'll take over all the responsibilities of those homes. So when you do a secured portfolio, that gives you a little bit of a different taste. Now, sometimes people just like to have their names on the title. And then there's the other side of that, that if you do a 1031 exchange with us, so say if you've gone out and sold a piece, or you're going to sell a piece of an investment property, and you want to do a 1031 exchange, which would allow you to not have to pay any taxes on that, then you would come in, you would sell your properties, we'd help you to open up a 1031 account, and then we would sell you X amount of properties to meet and hit the requirements of whatever your 1031 exchange is. And in that case, your name goes on the title again, and everything else happens exactly the same way. We lease the properties back, pay you a set monthly income, take over all the responsibilities of those properties. And that's the way the two deals work. Now let me finish one other thing on the secured portfolio. And I'm gonna pop back to the fund too right after this too. The other big question we always get is, how do I get my money back, right? How do I get out of this? Okay, so you've sold me properties. Well, we have a very beautiful way of doing this. We almost can make really real estate liquid for you. So when you're ready to either get out of your 1031 exchange and maybe do another one, which you could, or you're just ready to sell your properties, we buy the properties back from you. And that makes it very easy. And it's set up so that we buy the properties back from you at the original price that we sold them to you for. So basically protecting your principal that you have in the program. Now, sometimes people say, yeah, but isn't there some appreciation there? And yes, there is some appreciation. But what we've done is we've included about half of the appreciation that we're going to expect to get on those properties within your return of we're paying you on that set monthly income. So we're taking a little bit of a risk on our side that we can pay you that, and that will actually happen over a period of time. But we know the history of these homes. We know what's going to happen for the most part, not any short-term period, but we can look at the long-term period, and we'll be just fine from that perspective. So we include that in on the set monthly income. We buy those homes back from you. You don't have to go out and find a realtor or do anything else to get them sold, and then you can be out of that investment. And by the way, if you bought 5 homes from us and you want to sell us back one, you can do that too. The other thing that we didn't talk about is how do you get your money back out of the fund, and that is you just give us a 90-day notice, and then we'll redeem your money out of the fund. And many times it happens faster than that. It all depends on the timing and the variation of where we sit with cash and everything like that. And if it's a large dollar amount, it could take a little bit longer than 90 days. But more times than not, it can be done in 90 days or less. So that gives you a couple ideas of what we offer there for people to come in and participate. By the way, we have people that do both. We have people that buy homes, have their names on the title, and then they also put money into the fund. So, and that's kind of an interesting thing too. Instead of getting paid your set monthly income, if you want that to compound for you, you can take that money and open an account, or if you already have an account within the fund, to actually let that compound within there too. I also forgot one other thing that I didn't go over. You're probably going to ask me it next, actually. So I'm gonna beat you to the punch, okay? In a secured portfolio, you're going to make about 7.5% to 8% or so. That's a give or take, obviously, in your return if you do it all cash, meaning you come in, you buy those properties, and you do it without any kind of financing. But that is the other advantage that you get from the secure portfolio that you can't get inside the fund. You can actually finance the properties, and once you do finance the properties, you can usually get your return up to 12 to 16%. So many times it can be actually doubled by doing the financing. We'll help you to get set up. We have a preferred lender, and we're talking about getting normal, traditional mortgages, Fannie Mae, 30 years, very low interest right now. Today, you're in the 4%, right around the 4% number. And they're very beautiful mortgages that are out there. So again, one other advantage that you can do there, if you're willing to kind of go through a little bit of the hassle to get that financing done, but once it's done, and you've got a beautiful thing there. So, all right, now I'll let you go to the next one, or if you've got other questions coming in.
Well, this is a good opportunity to open this up for questions for our participants. So if you'd like to ask us anything, feel free to use the Q&A tool that's down at the bottom of the screen. Those questions just go to us and no one else sees those. And then I share them with Greg, and Greg answers for everyone to hear. It looks like we do have a couple of questions. This one's kind of a two-part question, but is it safe to take on debt right now to invest it? And could that debt become a problem during a recession?
Yeah, that's a really good question, because debt can be your friend or can be your foe. It can go both ways. I also like to call this smart debt and dumb debt. And I don't mean it to me demeaning when I talk about dumb debt, but what is that? Dumb debt is when you go and you use debt to buy things that basically you can't afford, but more importantly, they don't provide you anything from an income standpoint. So easy example would be you go on vacation, you buy an RV, you buy a ski boat, whatever it might be, and you're using debt to do that. Now we know back in the big recession there 10 years ago, that's what people were doing. They were taking out debt off of their homes and they were buying themselves all kinds of toys and then got themselves into trouble. So that's not the kind of debt you want to take on. But the question really is it a good time to do it? So debt is always a good time to do it. Either it doesn't matter when it is happening, if all the things line up correctly. So you have to buy the right asset, and in this case, we're talking obviously real estate. You have to have the right real estate that produces the right cash flow to put yourself in a safe position in the deal. And that's exactly what we do. We buy real estate that produces cash flow. If we get some appreciation on it, which we will over a long period of time, that's great, but that's not what we're counting on at all. And so if you take on debt and you take on some type of financing to buy these properties, you have the cash flow to always be taking care of that. Now, we even add another level of safety in there because, again, you're not buying 5 homes from us and hoping that all 5 homes stay occupied and you don't have some unusual, expense that comes along. Because of us leasing that back and we're putting everything within a portfolio of 750, you're really well diversified. So yes, we're going to always have vacancies and all those types of things. And yes, you're going to have some things that are kind of extraordinary that, a tenant completely destroys your house, but that doesn't destroy our portfolio and it doesn't destroy our return because it's so well diversified across all of that. So taking on debt to go buy these homes, and especially the financing that we can get today at 4%, it just doesn't get a whole lot better than that. And it puts you in a very, very safe position to do that. So we encourage people to do that because that's the best use of your money, of your cash that you're going to put in to make the best return that there is out there. Now, not everybody likes that. So some people, we've all probably been taught, you don't take on debt. That's the bad stuff. You try to pay for yourself. You try to pay off your house. You try to pay off all your investments. But in all reality, that's not the best investing way to go. But you have to do it smart, and you have to do it the right way. And when you do, then you're in a really good, safe place. And then debt is your friend and not your foe. So yes.
All right, we have another question here, and this is something you kind of touched on a little bit already, but why would someone invest in the fund over the secured portfolio and vice versa? Why would someone invest in secured portfolio over the fund?
Yeah, well, sometimes, let's say you're going to invest with your IRA or your 401k. Easiest way to do that is just to put that into the fund. You can certainly do it and we can make it happen, and you can do a secured portfolio, have your name on the title. It just adds a little bit more complexity to there. Like I said earlier, the fund's the easiest thing to do. You send us money and we put it in the fund, and you're immediately making the dollars on that. The secured portfolio gives you, it's a little bit more work to it. So we have to literally sell you the homes. We've got to go through a closing process. There's some expenses that are involved there, not a lot. But then the other side of that is you are secured by the title. So what kind of security does that give you? That's kind of one of the advantages. And the advantage to that is let's say that everything just goes horribly wrong, okay? And something happens to the fund and we no longer can pay that set monthly income. I don't know what that would be, but we're just trying to do this scenario. So hopefully that never ever can happen. But let's say it does, then with your name on the title, you can take those homes. Those are your homes, and you can go off and you can try to sell them if that's what you want to do. They're most likely still rented out, so you could hire a third-party property manager to continue to do that. Now, Nobody's probably wanting to come into this ever having to deal with that, but that does give you that little extra amount of security on that. Whereas if you're in the fund, then you're in with everybody else. Everybody owns their pro rata share. It's a little messier from that standpoint. But the fund could actually be better in that position too. So there's no way to know 100% on either one of those. I think the bigger advantage on the secured portfolio is that you could go finance it and make a bigger return on it. That's probably your biggest advantage overall. And then we do, like we talked about a little bit before, is 1031 exchanges. We do a lot of 1031 exchanges. And that is the only way to do it is through the secured portfolio because you have to have your name on the title. But what's kind of a cool thing about that is with 1031 exchanges, when somebody ends up selling their investment property, and so many times they end up owning those investment properties for a long period of time. So they've paid it way down. They might own it free and clear at this point, and they still have all the landlord hassles, no matter what that is, whether it's commercial or it's residential. When they do the 1031 with us, now they get it, all that equity is basically sitting in their home. It's not working for them like it did at one time before because they probably financed it to begin with. And so when they do that, what's really ironic is they can actually double their income and get rid of all their landlord hassles and not have any of those things that happen when they do the 1031 exchange. And we see that all the time with everybody that does it with us. I mean, sometimes they do way greater than doubling their income. But it's a really nice thing that happens to make it much easier. And that's why we always like to use our little phrase of be an investor and not a landlord. And we really can help people to do that.
All right, let's see. I think we've touched on some of the questions that came in. But here's one that we get pretty frequently, but who manages the properties and how does that work?
Yeah, this is why I like you asking questions and people asking questions because I forget to say these things, as we go through this. This is a really important part, and it's an important part of us being successful. It's all of our own team members, and when I say team members, that means they're full-time employees of ours. So every single place that we buy and manage our properties, we have a real estate brokerage that we own, we have property managers, and we have construction managers in each one of those places. And we do not buy or, we're not in those any place that we don't have. We have dealt with, like probably many people that are on this webinar today, third party property managers especially, where you struggle and struggle and struggle, and you're really not aligned with them. It's not their money, any of those things. And so as we hit enough economies of scale, which is around about the 300 mark of homes, we put our own people on the ground, which was always our intention. But we had to struggle through the first 300 because you had to deal with everybody else, all those third parties that it was just not a good way to go. So anyways, we have about 55 employees, and there are probably about 15 to 20 of them on the Midwest. So those are the people that we have in the Midwest that are on the ground there helping us to do everything from acquisition to construction management to property management. And the rest of them are here in Reno, Nevada, where our corporate headquarters is, and it works very, very well with that.
Well, I think we're getting close to the end of our time today, but Greg, did you have any final thoughts or talking points you wanted to touch on before we wrap up?
I don't know. Did I forget anything? Whatever
There's
I
always a
forgot,
lot.
I don't know what I forgot, again, thanks for participating today and coming to listen to this. We know that this is just a real quick overview, and it's not, in fact, it's kind of not very fun for me to even do this because I don't get to see anybody's face or meet with you in person or do a Zoom call or whatever. We would love to be able to do that with you and do a face-to-face, however that works today. So I know, Ashley, you're going to stick up some information at the end so you can get a hold of us. But yeah, so don't hesitate to call. We'd love to talk to you about your own situation, because everybody's got something different. We don't want to spend too much time on one thing here when, you're not doing a 1031 exchange, but somebody else is, etc. So other than that, thanks for coming, and hope to talk to you guys soon. Thanks.
Thanks so much, Greg. And like Greg mentioned, we're going to put up a screen here in just a moment that shows some contact information for how you can get in touch with our team so that you can set up a meeting either in person or via video chat. And sometimes we find that that's a better way to answer some of your questions in a more personal setting. And I'm going to go ahead and do that. Have my colleague go ahead and share that, Caitlin. You can also put your information in the Q&A box down below, and that information just goes straight to us. So if you have a preferred way that you'd like us to contact you, we're happy to do that. So go ahead and send that over. And that's all we have for you today. Have a great rest of your day.